You are welcome to the preparation of the partnership account. What do we mean by a partnership business or a partnership account? A partnership is a relationship that subsists between two or more persons carrying on business in common with a view to making profit. We said it's a relationship that subsists or that exists between two or more persons. That means there must be up to two persons involved. And these people are carrying on business with a view to making profit. So profit intention is there. The preparation of partnership account is not different from the common way that we prepare the financial statement of a sole trader. It involves preparing the statement of profit or loss account and also the statement of financial position. Of course, since they are carrying on business in common, no separate statement of profit or loss account or statement of financial position is required, as the business is treated as one. Now, in the preparation of the account of the partnership, there is an account that is unique in the partnership account, and that is the profit or loss appropriation account. It is in this account that the partnership or the partners makes certain distribution considering the amount due to each partner and the amount due from each partner. At the end of the period, the profit is shared according to the profit sharing ratio. Apart from the appropriation account, another important account that is unique in the preparation of the partnership account is the capital account of partners. The capital account can be fixed. The capital account can also be fluctuating. When we say that a capital account is fixed, what it means is that in such capital account of partners, only the initial capital introduced to start the business or additional capital introduced will be recorded in this account. The capital account can also be said to be fluctuating. When a capital account of partners is fluctuating, that means in addition to the recording of the initial capital introduced or additional capital introduced in the business, all fluctuations in relation to what is due to the partners and what is due from the partners will be recorded in the same account. However, in most cases, an additional account that looks like the capital account will be introduced and called the current account. What is the purpose of this current account? It is to take care of all the fluctuation that will occur during the partnership transactions. Thus, it will enable the capital account to be fixed, maintaining only the capital introduced by the partners or additional capital introduced. If the current account is introduced in any partnership business, what it automatically means is that the capital account is fixed. Since the capital account will no longer take care of the fluctuations, current account will take care of all the fluctuations, leaving the capital account to take care of only the capital of the partners. So, in most cases, when only capital account is introduced or shown in an examination in relation to partners account, it means that such capital account is fluctuating. When capital account and current account is introduced in a question in an examination, for instance, what it means is that the capital account is fixed while the current account is there to take care of the fluctuations. But if it's only capital account that is introduced, it means that such capital account will be fluctuating. So when we talk about fluctuating capital account, it means that the capital account will take care of all the recording in relation to capital introduced, another amount due to the partners and due from the partners. So in our treatment of partnership account at this our foundation stage, we are going to see how recordings will be made using the three unique accounts: the profit or loss appropriation account, the capital account, and the current account. The following must be taken into consideration. When you go through the data or the equation, there are certain terms or figures or items that you have to extract. No matter how lengthy the equation is, you only need this to prepare your partnership appropriation account, the capital account, and the current account. And these are: 1. Find out the net profit of the partners for the end of the accounting period. It is with this that you are going to prepare the appropriation account as at the end of the accounting period. Remember that when we were preparing the statement of profit or loss account of sole traders, we treated the trading area to obtain our gross profit. Then the gross profit was brought down and operation or operating expenses deducted before we obtained our net profit in the absence of any adjustment. It is in the same way that we obtain the net profit in the account of a sole trader, that net profit can also be obtained for partnership business, since it is the same way the sole trader runs their business that the partners also runs their business, maybe with little differences. Once the net profit of the partners is gotten, this net profit will be transferred to the credit of the appropriation account if it is a net profit. If it is a net loss, it will be debited to the appropriation account. The next thing you are going to watch out for is the capital account balances of the partners and the interest on such capital account. That is, the interest that will be paid on the partners for maintaining such capital account. After taking into consideration the net profit and the capital, the next thing is the current account. What are the balances outstanding in the current account of the partners? Then check if in the equation or data you have interest on current account. Then try and find out whether there is any drawings. That is, whether any of the partners collected cash or stock for personal use. Then find out if there is any interest on drawings. Then also try and find out from the data or question whether there is any salary, entitlement, bonus, or other benefits that is due or attributable to any of the partners. Then with this information, you can go on to prepare your appropriation account, the capital account, and the current account. Remember, you watch out for the following: the net profit of the partners, capital account balances of the partners, whether there is any interest attached to such capital account, current account balances of the partners, whether there is any interest attached to such current accounts, is there any drawings, is there any interest attached to the drawings, or entitlement to any of the partners. You must extract these things from any data or question, and with this, you will comfortably prepare the appropriation account, the capital account, and the current account of partners. And once this is done, the account is almost ended, as the preparation of the statement of financial position will pose little problem. In order to put everything we have just said in practice, I have extracted these details from a equation. And with these details, we are going to prepare the appropriation account, the capital account, and the current account of Victory Enterprises. Note, in any question that you are given, ensure that you watch out for these items that I'm going to point at now. And once you are able to extract these items, preparation of these accounts becomes simple. What is patient? We are going to prepare partnership accounts. And what we are actually preparing is in relation to Chooks and Ken partnership. The first thing we are going to show is the profit or loss appropriation account for the year ended December 31st, 2020. And we are going to be using the vertical format first. Now, the information extracted from the equation given or the data given shows that net profit for the year 31st December 2020 is $75,000. Then we have the capital account balances of Chooks. $100,000, Ken, $60,000. We have current account balances for Chooks is $20,000, for Ken is $10,000. Then we have the drawing accounts. Chooks drew 1,000, Ken drew 2,000. Interest on capital 5% per annum. PA means per annum. Interest on current account 3% per annum. Interest on drawings 2% per annum. Salary / bonus / allowances, Ken, $500 per month. Profit is to be shared in the ratio 3:2 for Chooks and Ken respectively. To prepare this account, you need the profit or loss appropriation account, which we have already shown here. Then you need the capital account and the current account. What this means is that the capital account will be fixed, while current account will take care of all the changes of fluctuation. We are going to see how we are going to make records in these two accounts. Now, to rule the capital account, you have the date, particulars, then the name of the first partner, Chooks, and the name of the second partner, Ken. The name of the first partner, Chooks, and the name of the second partner, Ken. That is the debit side of the capital account. Then on the credit side of the capital account, we still repeat date, particulars, Chooks, and Ken. So we have also the current account. The same way we have date, particulars, Chooks, Ken on the debit side. This indicates that Chooks and Ken are the partners. We repeat the same thing on the credit side. Date, particulars, Chooks, Ken. If you want the capital account and the current account, they are the same. The only thing is that two of these accounts has been prepared. One is called capital and one is called the current account, because these partners want to maintain a fixed current account. Why they will use the current account to treat all the fluctuation in respect of the partners. Let's begin our entries in these three accounts. Now, the first thing we do is to take the capital into consideration, the capital account balance. Chooks has 100,000, while Ken has 60,000. Also, in the current account, the balances that are existing is for Chooks 20,000 and Ken 10,000. So the first thing we do is to transfer these balances to the appropriate account. That is to capital account 100,000 and 60,000 for Chooks and Ken, and in the current account 20,000 and 10,000 for Chooks and Ken. Now the capital account of Chooks is 100,000 and the capital account balance of Ken is 60,000. We take it straight to the capital account. Under particulars, we have balance brought down. for the current accounting period, you can see Chooks 100,000 and Ken 60,000. Then the current account balances for Chooks is 20,000 and for Ken is 10,000. We go to the current account, we place it, balance brought down for the current accounting period, 20,000, and that for Ken, 10,000. Of course, the accounting year ends by December 31st, which means that these transactions are being brought down or brought forward at January 1st, 2020. Now, the next thing you take into consideration is the drawings, if any. The drawings account, Chooks withdrew $1,000, while Ken withdrew $2,000. Now, in the current account, this amount will be debited, that is, as a deduction from the amount they have in their current account. And this is one of the purposes of a current account. If the current account does not exist, these two balances will be added here. 20,000 here for Chooks and 10,000 here for Chooks. And the drawings will be debited here, meaning the capital account is what? Fluctuating. In this case, the capital account is fixed. And that is why we have used the capital account to record only the capital and nothing more. If there is any additional capital by either Chooks or Ken, it will also be added to this as additional capital in cash or in check. Now, the current account here is already credited. What this credit balance means is that Chooks has 20,000 deposited in the current account and Ken has 10,000 deposited in the current account as at the beginning of the period. The same is applicable to the capital account. And since the current account is taking care of all the fluctuation, any amount that the partners withdraw for personal use during the accounting period will be debited to this account. Of course, debit here means minus and credit means plus or addition. Here, credit also means addition, while debit means subtraction or deduction. So what we do is to debit the drawings by each of the partners in this account. You can see the drawings under particulars for Chooks is $2,000 and for Ken is $1,000. What this means is that of the total balance of $20,000 in Chooks' current account, Chooks has withdrawn $2,000. If you balance this account now, the balance remaining will be $20,000 minus $2,000, which is $18,000. For Ken, it will be $10,000 minus $1,000, which will be $19,000. So you can see these accounts are used for fluctuation. Any amount that is due to any partners will be added as a credit, while any amount that is due from any partner will be debited as a deduction. Now, having taken care of the capital account balances, the current account balances, and the drawings balances recorded, we are now going to look at the interest on capital for Chooks and Ken, and also the interest on current account for Chooks and Ken, and some other things that will be taken into consideration before we arrive at our final balances. Of course, any interest on capital will be an addition to the capital account. However, such interest will be added or credited to the current account as no fluctuation or changes is allowed here. Also, any interest on current account will be added to this account. Of course, we know that the interest on capital is there to encourage partners to invest more. A partner that contributed 100,000 and a partner that contributed 60,000 should have benefits for that. And that is why in this equation, interest on capital is 5%, which means that Chooks will receive 5% of 100,000 and Ken will receive 5% of 60,000, depending on the amount contributed as capital. Also, the amount maintained in the current account will receive interest. In this equation, interest on current account balances is 3%. So Chooks will receive 3% of 20,000 minus 2,000. While Ken will receive 3% of 10,000 minus 1,000. Let us look at how we are going to calculate the interest on capital and the interest on drawings. Before then, we are going to credit the net profit to the appropriation account, and most of the treatment will be carried out first in the appropriation account before we can now transfer them to the capital account and the current account as the case may require. So for now, we are going to calculate the interest on capital and the interest on current account and the interest on drawings to find out the amount involved, and thereafter we are going to see how they are going to be posted to the various accounts required. Having taken the balances that are existing at the beginning of the period to the capital account, the next thing we do is to find out the profit for the period. Of course, we have seen the net profit made. Net profit is 75,000. This profit would have just been shared by the partners without taking anything into consideration, but it is wrong in partnership account. From this $75,000 profit made in the current year, the partners will pay themselves interest on capital, interest on current account. They will pay themselves salary, if any. So for now, let us go and calculate the interest on capital, interest on current accounts, interest on drawings. Of course, the salaries or allowances has been clearly stated. The interest on capital is 5%, and the capital balance for Chooks is 100,000. That means we are going to calculate 5% of 100,000. Then for Ken, it is 60,000. Then the interest on current account is 3%. Interest on current account is 3% per annum. We are going to calculate 3% of 20,000 for Chooks and 3% of 10,000 for Ken. Then the interest on drawings is 2% per annum. We are going to calculate 2% of 1,000 for Chooks and 2% of 2,000 for Ken as interest on drawings. So to do that, we work that out. In the workings, we have workings 1, interest on capital. We have for Chooks, 5% means 5 over 100 times 100,000. That gives us $5,000. Then for Ken, interest on capital is 5 over 100 times 60,000. That is 5% of 60,000, which gives 3,000. Then we have the interest on current account, which is 3%. For Chooks, is 3 over 100 times 20,000, gives us 600. Then for Ken, interest on current account is 3 over 100 times 10,000, which gives 300. So interest on current account for Chooks is 600, and interest on current account for Ken is 300. Then interest on drawings. From the analysis done, drawings by Chooks is 1,000, while drawings by Ken is 2,000. And the interest on drawings is 2% per annum. So calculating that in workings 3, we have interest on drawings for Chooks. 2% is the same as 2 over 100 times the drawings for Chooks, which is 1,000. That gives us $20. Then for Ken, 2%, which is 2 over 100 times drawings by Ken, which is $40. Now, having known the interest on drawings, interest on capital, and interest on current account, our account is almost concluded. So let's go to the appropriation account and carry out the analysis. The first thing we add to the net profit of the partners is interest on drawings. We have calculated this. Chooks is $20, while Ken is $40. $20 plus $40 gives us $60. We extend it and add it to this $75,000. Why are we adding interest on drawings? Some of the partners withdrew money for personal use, and the law in this partnership or in the partnership deed is that anytime any partner withdraws money for personal use, that partner has to pay interest on such drawings, because if the partner did not withdraw the money as shown here, then they will use the money not withdrawn to run the business. And since the money has been withdrawn, such partners that withdrew the money has to pay in as interest into the partnership account, which will be credited to the partnership account. So we are adding this 60 because it is an amount due from the partners. Both Chooks and Ken withdrew money for personal use, and they are paying in interest of 20 and 40, which makes up 60. Another reason for interest on drawings is to discourage partners from excess withdrawal of cash or stock for personal use, knowing that anytime you withdraw cash for personal use or stock for personal use, you have to pay interest. This may discourage the partners from withdrawing from the business. However, both of them withdrew, and 20 plus 40 is giving us 60, which will be added to the $75,000 to give $75,060. So if you add this 60 to $75,000, it gives $75,060. Now this is the total amount that the partners have for the period. Now the next thing they are going to take into consideration is the deductions. Those amounts that has to be deducted from this $75,060 in order to arrive at the amount available to be shared as profit between the partners. And this includes the salaries paid. In this question we have the salary, bonus and allowances paid to Ken is what? $500 per month. And since the business is operating from January and ending 31st December 2020, what it means is that from January 1st to 31st December 2020 is 12 months. And since Ken is being paid salary of $500 per month, it means that the salary will be $500 times 12 months, which will give $6,000 as salary due to Ken. Probably because Ken was participating actively in running of the business. So we have under workings 4, salary to Ken, $500 times 12 months gives us $6,000. And therefore, we now enter it into the appropriation account. Salary due to Ken is $6,000. Remember that all these are what? Deductions, so it has to be in brackets. Then after that, we take into consideration interest on capital and interest on current account. We let salary to Ken, which is $6,000, and extend the balance. Then the interest on capital, they will pay themselves interest on capital for their effort in bringing in the capital. Chooks will receive $5,000, then Ken will receive 3%. Now the total interest on capital for Chooks is $5,000, for Ken is $3,000. 5,000 plus 3,000 is 8,000. We rule a line and extend the balance, 8,000, to be deducted from this again. Now we now have interest on current account. Chooks' interest on current account is 6,000, and Ken's interest on current account is 3,000. And this amount is now being calculated and extended as a deduction. Then we deduct 6,000 salary, we deduct 8,000 interest on capital, we deduct 900 interest on current account, and we now have $60,160 as divisible profit to the partners. This is the profit that they will have to divide. Now we have $75,060 total amount that belongs to the partners, minus salary of 6,000, minus total interest on capital of 8,000, minus total interest on current account of 900, then we have $60,160. This is now the divisible profit. That is the amount that the partners will share as profit, having settled themselves in all respect. Of course, we understood that interest on drawings was paid in. So it's an addition to the net profit made because the partners collected money from the business and paid in interest. If they had gone to the bank to collect this amount that they withdrew, they would have paid interest to the bank. So paying the interest to the partnership means it's a positive or addition to their money. Then the salary was paid to Ken of 6,000 and deducted from this. If Ken did not work and they had hired a worker, they would still pay that worker 6,000. And that is why this money must be deducted from the total profit. Then the interest on capital was paid from this amount because if they had gone to the bank to borrow this money to run the business without contributing it themselves, they would have paid the bank interest. So that now they are paying themselves 5,000 and 3,000 respectively, which resulted to 8,000. The same is interest on current account. The amount they left in the balance of their current account gave them this interest. If this amount was also borrowed, interest will also be paid by them. So they are now paying themselves 600 and 300 respectively, which gives 900. So we have 75,060 minus 6,000 minus 8,000 minus 900 gives us $60,160. And this becomes the divisible profit. In this question, interest on current account is supposed to be 20,000 minus 2,000, which is 18,000 for Chooks, and 10,000 minus 1,000, which is 9,000 for Ken. But in an examination condition, it is the instruction of the examiner that prevails. Now, in this question, in an exam, we were told that interest should be calculated on current account without taking the drawings into consideration. So the interest now was calculated on the $20,000 and on the $10,000. Probably that was the agreement of the partners written in partnership deed. It is any instruction that the examiner gives you that prevails in the examination. Even if there's a law guiding the partnership transaction or account or partnership business, and an examiner gives you an instruction in exam, you must obey it. So I'm pointing to a fact to you now that you must obey that instruction without questioning. So in this question, interest on current account was calculated on 20,000 and 10,000. And of course, this is the amount due to the partners which have been deducted from the profit before divisible profit. It is not appropriate that profit should be shared without taking these things into consideration, because some partners may not be happy with the arrangement. For instance, if they don't pay Ken salary, Ken will not be happy because Ken is an active partner and have been working. If the interest on capital is not paid to Chooks and to Ken, especially Chooks, Chooks may not be interested in bringing in additional capital since no benefit. Interest on current account still bears the same burden. Of course, anybody that leaves money in the current account has to receive some interest because they will still use this money in running the business. So, having settled this transaction, the final amount to be shared or divided as profit is 60,160. So the share of profit in this question, we assume that Chooks is to Ken is 3/2. That is 3 for Chooks and 2 for Ken. The sum ratio should be 3 plus 2, which is 5. So Chooks will receive 3/5 times the divisible profit, while Ken will receive 2/5 times the divisible profit. So we now have share of profit. The divisible profit is $60,160. Then we now share it. Share of profit, Chooks will receive 3/5 times 60,160. That is this. And that gives us 36,096. Then Ken will receive 2/5 times 60,160. That is the same amount. And it gives 24,064. If you add 36,096 plus 24,064, it will give 60,160, which is the same figure as this. Of course, the profit has been equitably shared. Therefore, the total profit shared is 60,160. That is 6,096 plus 24,064, which gives us 60,160. Of course, you can see they are all deductions from the profit. So from the profit, Chooks will receive this and Ken will receive this. And if you extend the two balances, which is 60,160, we now have 60,160 minus 60,160, which now gives us a nil balance, or zero. Everything about the partnership has been settled. The next thing we do is to post this transaction to the capital account and current account and give interpretation to them. And that brings to an end the treatment of profit or loss appropriation account and the treatment of capital account and current account in respect of partnership account. At this stage, we are going to transfer all the records made in the appropriation account to the partner's current account, since it is the current account that takes care of all the fluctuations. Firstly, we must note that any amount that is due to any partner will be credited to the current account of such partner, and any amount that is due from the partner will be debited in the partner's current account. At the end of the period, the amount due to each partner or due from each partner will be shown as balance brought down. You will observe that every figure or items added to the net profit will be deducted or debited to the current account. How? Interest on drawings were paid in by the partners, and this amount was added to the net profit. And what is interest on drawings? Interest on drawings represents amount demanded from the partners or due from the partners for withdrawing cash for personal use. And this has been added to the business net profit. However, the treatment in the current account is to debit this amount to the current account of the partners because it is an amount demanded from them for withdrawing cash or stock for personal use. Interest on drawings of $20 has been debited to Chooks' account, while interest of drawings of $40 has been debited to Ken's account. This means that from the credit balance of Chooks, $20 will be deducted as interest on drawings. And from the $10,000 credit balance of Ken, $40 will be deducted from Ken's account as interest on drawing. So any amount due from each partner will be debited in the current account. And any amount that belongs or due to a partner will be credited to the current account. Meanwhile, the capital account remains static because we are maintaining a fixed capital account. Since current account will take care of all the fluctuations. Salary to Ken is $6,000. This is an amount due to Ken as it was deducted from the profit. So as they are deducting it from the profit, they are adding it to Ken's account because it is an amount due to Ken. So we go to the current account and credit salary to Ken's account, $6,000. So we credit salary to Ken's current account. Recognize that any amount deducted from the appropriation account is credited to a particular partner. And that is exactly what we have done. Salary was deducted from the profit, so it belongs to a partner, Ken, and has been added or credited to Ken's current account. Ken's account has now increased to $16,000, that is $10,000 plus $6,000, minus $1,040. Interest on capital, Chooks, $5,000, Ken, $3,000. These amounts were deducted from the total profit of $75,060. That is $5,000 plus $3,000, which is $8,000. Any amount that is deducted in the appropriation account means they belong to the partners and has to be credited to the current account. So we go to the current account and credit for Chooks $5,000 and Ken $3,000. So we credit the interest on capital to Chuck's current account 5,000 and to Ken's current account 3,000. This is the amount being given to them for their contribution to the capital of the business. Interest on current account, Chuck's 600, Ken 300. This has been deducted from the total profit. That is 600 plus 300, which gives 900. Therefore, they belong to Chuck's and Ken and have to be credited to their current account. Of course, they are getting this as a benefit for leaving some money in their current account, which now has generated interest. After Chuck's and Ken has received their interest on current account, then the amount remaining is 60,160. That is 75,060 minus 6,000 for salary minus 8,000 for interest on capital minus 900 for interest on current account. Then the balance remaining is 60,160. Now this 60,160 will now be the divisible profit to be shared by the partners according to their profit sharing ratio. Of course, other things that have been shared to the partners was due to their contribution in the business. Chuck's contributed capital, Ken contributed capital, and they have been given their interest. Chuck's has some money in his current account balance, and Ken has. They have been given some interest. It is after the settlement of this interest and salary in proportion of the amount contributed by each partner that the balance remaining will now be shared according to their profit sharing ratio. Of course, the profit gotten by Chuck's is 36,096 and the profit gotten by Ken is 24,064. It is also a deduction and has to be credited to their current account because the share of profit is part of their benefits in the business, just like the interest and the salary. The only difference between the interest, the salary, and the profit is that this has to be settled before they will now know the amount remaining to be shared as profit according to their profit sharing ratio. So we now go and credit Chuck's with 36,096, his share of profit, and credit Ken with 24,064, his own share of profit in the current account. Then we have the share of profit for Chuck's 36,096 and for Ken 24,064. Now, to balance the account of Chuck's, the current account of Chuck's, we add everything due to Chuck's and deduct everything due from Chuck's. Now, if we add, we have 20,000 plus 5,000 plus 600 plus 36,096. Then any figure we get from this, we minus 2,000 plus 20, then we now get the balance CD, showing the closing balance of Chuck's at the end of the period. For Ken, so if we add 10,000 plus 6,000 plus 3,000 plus 300 plus 24,064, any figure we get, we minus from it 1,000 and also minus 40. Then that will represent the balance carried down for Ken's account. That is, in the same way, we are going to balance the capital account, and the amount we are going to get is the balance CD, which is the same as 1,000 for Chuck's and 60,000 for Ken. Then when we are done with the balancing, the amount standing in the balances of Chuck's and Ken will be shown in the current account and also in their capital account. All the amount belonging to Chuck's can be calculated as 20,000 plus 5,000 plus 600 plus 36,096, which gives 61,696. Then deduct all the amount that is due from him. The amount he withdrew, 2,000, plus interest on the amount he withdrew, 20, gives us 59,676. That is the balance carried down for Chuck's current account. That is closing balance for Chuck's current account. Of course, this amount, when added to this and this, gives 61,696. That is 2,000 plus 20 plus 59,676. In the same line with this, our usual way of closing, this account is closed. Then, the balance CD of 59,676 is now brought to the credit side as balance brought down 59,676. Of course, it is this same figure, the closing balance, that now becomes opening balance for the next accounting period. Then for Ken's current account, the total amount that belongs to Ken can be calculated as 10,000 plus 6,000 plus 3,000 plus 300 plus 24,064. That gives us 43,364. Then we deduct amount due from him, the drawings of 1,000 and interest on this drawing of 40. So we have 43,364 minus 1,000 minus 40 gives us 42,324. This is the closing balance for Ken's current account. Also, if you add 1,000 plus 40 plus 42,324, we are going to get 43,664. That is closed here in the same line with this. Of course, the balance carried down, which is 42,324 for Ken, comes to the credit side and becomes balance brought down for the next accounting period, 42,324. For the capital account, the balancing is very simple because it is fixed. The 100,000 for Chuk's capital account eventually becomes the balance carried down, still the same figure, 100,000, because the two sides must be equal. Then for Ken, the 60,000 balance in Ken's capital account still becomes the balance carried down. Of course, we have already learned how to balance during our treatment of double entry, that is the cash book. Therefore, we bring this down as 100,000 and bring this down as 60 and close in the same line with this. Then all the balance carried down on the debit side for Chooks 100,000 comes to the credit side under the closed balance to become balance brought down. For Ken, the same, 60,000 balance carried down comes under the closed balance to become balance brought down for the next period. You can attach dates to all these transactions. For the opening balance, this should be January 1st, 2020, and the closing balance, that is balance carried down, should be by 31st December 2020. Also, the transaction for current account, the opening balance should be January 1st, 2020, while other transactions should be 31st December, because that is when salary, interest on capital, interest on current account, and share of profit are computed. Again, the drawings was made at the end of the year. That was why the drawings was not deducted from the current account balance before calculating the interest on current account. Also, the interest on drawings is at 31st December and the balance carried down is also at 31st December 2020. Now you can see the dates attached. 2020 January 1st opening balance, then 2020 December 31st closing balance. You can see 2020 January 1st balance brought down, that is opening balance. Others were at 31st December because they were computed at the end of the year. On the debit side, 2020, the drawings was made on December 31st and yet interest was still calculated on it by that December 31st. And the closing balance also on December 31st. That is where it is necessary for you to attach it. Then observe that for the current account, the balance brought down is 2021 January 1st. That is the following year after 2020. Then also for capital account, the balance brought down is in 2021 January 1st. Because whenever there is balance carried down by 31st December, the balance brought down becomes by January 1st of the following year. Of course, in this account, you should bear something in mind, and that is that anytime any item is added to the appropriation account, such amount added or credited should be debited or deducted from the current account. On the other hand, any amount that is deducted from the appropriation account or debited to the appropriation account, such amount deducted in the appropriation account must be added or credited to the current account. That should be a point to note in treating the appropriation account and the current account. Now, let's take down an assignment. Assignment. Chooks and Ken has been in a partnership business, sharing profit in the ratio 3:2. Their partnership deed contained the following. The partners will maintain fixed capital of Chooks 100,000 and Ken 60,000, both credit. 2. Ken to receive a monthly salary of $500. 3. Interest on capital is 5% per annum. 4. Interest on current account is 3% per annum. 5. Interest on drawings is 2% per annum. 6. The current account balance of Chooks and Ken has a credit balance of $20,000 and $10,000 respectively as at 1st January 2020. And Chooks and Ken withdrew cash of $2,000 and $1,000 respectively for personal use on 31st December 2020. You are required to show the following accounts for Chooks and Ken partnership. A. Profit or loss appropriation account. B. Capital account of partners. C. Current account of partners. Note, the interest on current account should be calculated based on the balance in the current account at the beginning of the accounting year, 1st January 2020. By the time we go into detailed treatment of the partnership account, we are going to explain certain terms. For instance, we are going to look at what we mean by deeds of partners, which is a law or agreement between the partners that states how the partnership business should be run. We are also going to look at type of partners. We have the general partner, we have the sleeping or dormant partner, and we also have the limited partners. These and many others in relation to partnership account will be treated theoretically and practically when we advance in our treatment of partnership account. For now, this will be okay for our foundation knowledge in the treatment of profit or loss appropriation account, the capital account, and the current account, which are unique features of partnership account. Note, the profit or loss appropriation account, the capital account, and the current account are the solution to the assignment. But try the assignment on your own. The answer you get will be the same with this, and this. That is the profit or loss appropriation account, the capital account, and the current account.